Not every investment belongs in your retirement plan. Some are built for long-term growth, others offer stability, and a few offer the worst of both worlds. In this video, I've ranked 7 common retirement investments from worst to best, including ones I'd never recommend. Hey, I'm Chris Strano, founder of SuperGuy.com.au and managing partner at Toro Wealth, where our vision is to be Australia's most trusted retirement planning firm. If you're new here, hit subscribe for regular retirement planning tips. And just a reminder, this video is general information only, not personal advice. At this stage of life, the goal isn't just growing wealth, it's protecting what you've built, generating reliable income, and making sure it lasts as long as you do. So when it comes to building a retirement investment strategy, there are a few key factors you really need to weigh up. These include security. You want to know your money is safe. Reliability of income. Your retirement income should arrive when and how you expect it. Consistency of returns. You'll want assets with a track record of steady long-term performance. Flexibility. Your income strategy should adapt as your needs change. Liquidity. You want access to your money when you need it. And keeping up with inflation, so your money doesn't lose purchasing power over time. So these are the criteria I've used in ranking the different retirement investment options. And just a quick clarification, a lot of people think superannuation is an investment, but super is not an investment. It's simply a structure that holds your investments and gives you concessional tax treatment. Now, your retirement investments can be held either inside super or outside super, but for this countdown, we'll focus purely on the types of investments themselves. So let's rank them from worst to best, and we'll start with the most controversial. Number 8, cryptocurrency, specifically Bitcoin. Most of you have probably heard of Bitcoin. It's a form of digital money that isn't controlled by banks or governments. Instead, it runs on something called blockchain, basically a public record that tracks every transaction. Bitcoin has made headlines for delivering huge returns over the past decade, but also for its extreme volatility. In fact, it's not unusual to see the price fall by 50% or more in just a few months. So what are the pros? High returns. Bitcoin has delivered some of the highest of any asset class over the past decade. It's highly liquid. You can buy and sell it anytime, day or night, and it can add diversification to a portfolio. And the cons? Extreme volatility. Prices can swing up or down dramatically in very short time frames. No income stream. Unlike property, shares, or annuities, Bitcoin doesn't pay dividends or interest. And its future is uncertain. It's still relatively new and its long-term use is yet to be proven. Plus, security can be a risk. You need to manage how and where you store it to avoid hacks or losing access. My conclusion, Bitcoin is speculative and too volatile for retirement. It might perform well long-term, but it's not stable enough when you need certainty. So while a small allocation to crypto might be beneficial, putting your entire retirement savings into Bitcoin is far too risky. My rating for Bitcoin as a retirement investment, 2 out of 10. From one extreme to another, let's go from the riskiest to the safest. Next up, number 7, bank accounts. A bank account is the most basic option out there. You pop your money in, the bank pays you a bit of interest each month, and that's about it. It's simple, easy to set up, and everyone knows how to use one. Now, I'll be honest, they're such a poor investment for retirement, they almost didn't make the list. But many retirees still use bank accounts as their main or even only investment. On average, you're looking at about 3% per annum, average return over 30 years. The pros of bank accounts are a stable balance that only changes when you add, withdraw, or earn interest. Immediate access. You always know exactly how much you have and you can get to it immediately. There are usually no fees and your money's safe. Government guaranteed up to $250,000 per person per institution. But the downsides are significant. Low interest rates compared to other investments. And the real killer, inflation. Over time, the purchasing power of your money falls because your returns don't keep up with rising prices. So my conclusion? Bank accounts are safe, passive and easy, but they are too conservative and won't grow your wealth in retirement. They're fine for emergency funds or short-term expenses, but that's about it. I would never recommend bank accounts as your only investment in retirement. My rating, 3 out of 10. So if bank accounts are too safe, are term deposits any better? Let's find out. Number 6, term deposits. With a term deposit, you put in a lump sum into a bank, lock it away for a set time and earn a fixed interest rate. At the end of the term, you get your money back plus the interest earned. Terms can be as short as 1 month or as long as 5 years. On average, you're looking at around 4% per annum return on average. So for every $100,000 invested, you'd earn about $4,000 in income per year. The pros, just like a bank account, your balance is stable. There's no fees and they're government guaranteed. The cons, returns are still low compared to other investments. There's no immediate access. Money is locked away for an agreed period of time. And just like bank accounts, inflation eats away at your purchasing power over time. So would I recommend term deposits for retirement? Well, I guess they're a step up from bank accounts, but still pretty limited. They can make sense for short to medium term expenses or as a safe place for a portion of your money, but with retirement often stretching 30 years or more, you'll usually want to combine them with some growth investments. My rating? 4 out of 10. Now, if you're looking for a bit more growth, you'll need to step out of the bank and into other markets. Coming in at number 5, international shares. International shares simply mean owning part of companies based outside of Australia. They offer the chance for long-term growth and sometimes dividends, though neither are guaranteed. Think of big names like Amazon, Apple, Toyota, Nestle. You can buy international shares through trading platforms offered by banks, as well as some industry and retail superannuation funds, and history shows that over 30 years, international shares have returned about 9% a year. So what are the pros? Well, they provide growth and income, helping your savings keep up with inflation. Diversification across countries, industries, even emerging markets, so you're not putting all of your eggs in one basket. Easy access. You can invest through Australian fund managers. And good liquidity. Just like Aussie shares, you can buy and sell quickly. But the downsides? Harder to navigate. It's not always clear where and how to invest overseas. Higher brokerage costs if you want to buy individual companies directly. And generally lower dividends than Australian shares and no franking credits, so they're less tax effective. So are international shares worth it? Well, they can be a great way to diversify your portfolio. After all, Australia is only 2% of the global share market, but they're harder to buy directly, cost more to trade, and global events can hit them suddenly. That's why I rate them 5 out of 10. Okay, moving on. At number 4, it's the classic Aussie love affair, investment properties. An investment property is a residential or commercial property you own but rent out to someone else. And the idea is that the property grows in value over time and you earn regular rental income along the way. On average, property returns around 8 to 9% per year after costs. But is it the right fit for retirement? Let's look at the pros and cons. The pros: regular income from rent, usually under a fixed lease. Long-term growth, as property values tend to rise. And it's a tangible asset. You can see it, touch it, even drive past it, which gives many people peace of mind. The cons: concentrated risk. If most of your wealth is in property, you're not diversified. Property is illiquid. You can't just sell a slice. It can take months to sell, especially if there's a downturn. Tenants' rights are increasing, which can make life as a landlord more difficult. High ongoing costs like agent fees, maintenance and rates, and insurance add up, plus big one-off costs like repairs or renovations. And don't forget stamp duty when buying and selling costs when you exit. That sounds like a lot of cons, right? So my conclusion: Australians love property but sometimes overlook its drawbacks. Investment properties can provide stable income and decent growth, but they do come with unavoidable running costs, time commitments, and a lack of immediate liquidity. My rating for investment properties, 6 out of 10. And just remember, we're looking at these purely as retirement investments. So before the property lovers come after me, keep that in mind. Property might be tangible, but number 3 is all about certainty, and that is lifetime annuities. A lifetime annuity is designed to pay you a guaranteed income for the rest of your life, no matter how long you live. Here's how it works. You hand over a lump sum, maybe $300,000 or $400,000, and in return you get a fixed regular payment of, say, $2,000 a month for the rest of your life. The exact income you receive depends on a few things like how much you invest, the interest rate on offer, your age when you start, and your life expectancy. But right now, annuities can offer about 5% per annum depending on the economic environment. You can buy them through banks or specialist providers. So what are the pros? Well, they're designed for retirees, often with favourable Centrelink treatment. Guaranteed income. You know exactly what you'll receive for life. And best of all, your payments aren't affected by market crashes or volatility. And the cons? Lower returns compared to shares or property over the long run. Locked capital. Once you buy an annuity, that lump sum is locked away. You generally can't make withdrawals, and they're not designed to provide liquidity. My conclusion? Annuities are a conservative option that offer certainty and peace of mind, but not much flexibility. They can make sense as part of your retirement income, but relying on them entirely could feel restrictive. My rating, 7 out of 10. Annuities give you certainty, but what if you still want some upside? My number 2 investment option for retirees is Australian shares. When you buy shares, you're buying part of ownership in local companies. The benefits? Long-term growth as share prices rise and income through dividends, which are often tax effective thanks to franking credits. To invest, you'll need a way to access the share market. If you're buying shares in your personal name or through a self-managed super fund, you'd usually open a trading platform account. If you're with an industry super fund or retail fund, you'll need to check if they offer a direct investment option for trading shares because not all of them do. Historically, Australian shares have returned around 8 to 9% per year, making them one of the most powerful long-term growth options for retirement. The pros? They're familiar companies you'll often recognise, maybe even use every day. A strong balance of income and growth over the long term, and high liquidity. You can buy or sell quickly when you need to. The cons? The share market is volatile. Prices go up and down and sometimes sharply. Companies can cut dividends if the economy slows and share prices can fall. And for many people, working out which shares to buy can feel confusing or overwhelming. So while Australian shares have solid advantages, they're not without risk, and it's important to know how they fit into your overall retirement strategy. So are Australian shares a good option? For most Australians, yes. They're familiar, accessible, and offer long-term growth with tax-effective dividends. A well-diversified share portfolio can also keep pace with inflation. But here's the catch. Relying only on Australian shares in retirement isn't for the faint-hearted. We've seen the share market drop by more than 50% at times. That's why Australian shares usually play an important role, but should only be one piece of a broader, well-balanced strategy. My rating is 8 out of 10. Finally, we've reached number 1, the investment I believe tops them all, a diversified index managed fund or ETF. So what is it? Well, a diversified index fund gives you exposure to a broad range of asset classes, shares, property, bonds, and more, all bundled together at a low cost. It's a passive set and forget option that requires very little input. The pros? Flexible risk level. You can choose how conservative or aggressive you want to be depending on your risk tolerance and goals. Low cost, giving you exposure to multiple asset classes, industries, and regions all in one fund. They're a good mix of capital growth and income, and they're simple to manage, and buying or selling is straightforward and relatively quick. The cons? There's limited transparency. With thousands of assets, you won't know every single holding. Fees do apply, though they're deducted inside the fund and are generally very low compared to active management. And volatility is possible. An aggressive fund could swing by 40% or more in a single year. But here's the bottom line. A diversified index fund is low cost, simple, and provides more predictable long-term returns at a level of risk you're comfortable with. You can choose a lower risk fund with long-term returns of around 5 to 6% or take on more risk for the potential of 8 to 9%. And having that choice can make your retirement outcome far more certain. For this reason, my rating is a 10 out of 10. If I were building a portfolio for my own retirement, this would be my foundation. So now that you've seen my rankings along with the pros and cons of each option, here's the best piece of investment advice I can give you. Reverse engineer your retirement plan. Figure out the amount of capital you need along with the investment returns to meet your retirement goals. Let me explain how to do it. Step 1. Define your retirement objectives. What do you want life to look like when you stop working? How much will you spend each month? Will you travel regularly, renovate the house, buy a caravan? Step 2. Work out the capital you'll need and the average return required to achieve those goals, factoring other income sources like the age pension. Step 3. Choose investments that have a high probability of delivering those returns over the long run, ideally 30 years or more. For example, you might decide you need $750,000 at age 65 to generate $60,000 a year at an average return of 6.5%. From there, you'd look for a diversified fund that historically aligns with that level of risk and return. And that's exactly why I rate a low-cost diversified index portfolio a perfect 10 out of 10. You can adjust the risk level, target the return you need, and benefit from the broad diversification all at a low cost. And finally, remember this is general information only. It's always best to get personalized advice from a licensed financial advisor before making any big investment decisions. That's exactly where we come in. Our team helps Australians 55 and above optimise their financial position in the lead up to retirement. If you're interested in learning more, head over to torowealth.com.au. If you found this video helpful, hit the thumbs up button, subscribe to the channel for more retirement planning tips. See you on the next one.